let's talk about the money sitting in your bank account. Right now, it's probably earning what? Next to nothing? But what if that exact same cash could be earning a real return, something like 5%, and you could still spend it instantly? Well, by 2026, that's not some far-off dream. It's the new reality. Your cash is about to get a radical high-performance upgrade. It's called tokenization.
I mean, just think about it for a second. We live in this instant, always-on world, right? But our money? It's still stuck in the dark ages, operating on banker's hours. If you need to send a big chunk of money on a Friday night, guess what? You're waiting till Monday morning. This system isn't just a little slow and clunky. In a world that moves at the speed of light, it's fundamentally broken.
But that is all starting to change. And look, we're not talking about some minor tweak here. We are talking about a complete reimagining of what cash can actually do. This whole transformation is being powered by blockchain technology, and it's making our money faster, smarter, and for the very first time, truly productive.
So, to really understand where all this is going, we first need to be brutally honest about where we are right now. Let's dig into why the cash you're holding today is just so fundamentally inefficient.
The problem is, your cash is lazy. It just sits there. A standard wire transfer has to bounce between a whole bunch of different banks, a process that can easily take 1 to 3 business days. And your access? It's limited to the hours your bank decides to be open. Thinking about sending money overseas? Get ready for some pretty hefty fees. But the worst part, the absolute worst part, that money in your savings account is probably earning a pathetic 0.01% in interest. That means every single day it's literally losing value to inflation. So what's the fix? Well, here's the surprising part. This isn't some fringe idea cooked up by crypto fanatics. No, this revolution is actually being led by the biggest names in finance. It's all because of a massive institutional pivot that is happening as we speak.
For years, the big players, they just stayed on the sidelines. Why? Regulatory uncertainty. But that's over. In 2025, huge pieces of legislation like the Genius Act created a clear federal rulebook for stablecoins. And at the same time, regulators like the SEC, that's the Securities and Exchange Commission, and the CFTC, which oversees commodities, they started clearing away major roadblocks. This was basically the giant green light that all the trusted institutions were waiting for to jump into this space in a huge way.
And the result of that green light? How about this number? $35 billion. By 2026, that's the projected value of real-world assets that have been tokenized and put on-chain. This isn't just some wild guess, it's already happening. Financial giants, we're talking BlackRock and JP Morgan, are actively taking assets like US Treasuries and turning them into liquid, programmable tokens on a blockchain.
So what exactly is this new smart cash? Let's break down how it actually works. It's a pretty simple idea, really, especially when you compare it to something you might already be familiar with.
This comparison pretty much tells the entire story. On the left, you've got a traditional money market fund, a safe place to park your cash. It settles in about a business day, and you can only touch it during market hours. Now on the right, you have its 2026 upgrade, a tokenized treasury fund, like BlackRock's BUIDL fund. It settles in seconds. It's accessible 24/7, 365 days a year. And instead of these confusing reports you get every quarter, every single transaction is recorded on a public, unchangeable ledger. It's taking a familiar, trusted asset and putting it on digital rails for the modern world.
The secret sauce here is a technology called tokenization. It's a fancy word, but all it means is creating a digital twin of a real-world asset on a blockchain. This token is your proof of ownership of the underlying asset, say a US Treasury bill. And because that ownership is now just a piece of code, it can be sent anywhere in the world directly to another person in a matter of seconds.
Okay, this all sounds really cool from a tech perspective, but what does it actually mean for you? What's the payoff? Well, let's talk about the two massive benefits: incredible speed and meaningful yield. Okay, this is the old way. We've all been through this. You start the transfer, then your bank sends it through this complicated network of other banks. The recipient's bank finally gets it, and then eventually the money shows up in their account. It's this slow, multi-day process that relies on a whole chain of middlemen.
Now, here's the new way. You send a token directly from your digital wallet to someone else's. The blockchain confirms it. Boom. Done. We're talking 2 to 5 seconds. No middleman, no waiting for the bank to open, no 3-day settlement period. It's literally the difference between sending a letter in the mail and sending an email.
But speed is only half the story. Remember, that token represents a real productive asset, like a US Treasury bill. That means while you're just holding it in your wallet, it's earning the yield of that treasury, which is around 5% in today's environment. Your cash is no longer lazy.
It is constantly working for you, 24/7, earning a real return, all while staying completely liquid and spendable.
All right, now before we get too carried away with all the good news, we have to talk about the brutal truth. This new level of power and efficiency comes with a completely new set of risks. The old safety nets you're used to, they're gone.
This quote, and this is directly from a major crypto exchange's website, says everything you need to know. The protections that you just take for granted, things like FDIC insurance on your bank account or SIPC insurance for your brokerage account, they do not exist here. When you operate in this new system, you are stepping outside of those traditional financial safety nets.
Let's be crystal clear about what these new risks are. First, you have smart contract risk. The code that manages your money could have a bug. A major platform called Balancer was hacked for $128 million, all because of a tiny vulnerability in its code. If that code breaks, your safe cash is just gone. Second, there's counterparty risk. You are trusting the institution that issued the token. If they go bankrupt, like we saw with firms like FTX, your assets can just vanish overnight. And finally, and this is maybe the most important one, there's self-custody risk. In this world, you are your own bank. You control the keys. If you lose your password, that 12-word seed phrase, your money is gone forever. There is no forgot password button. There is no customer support line you can call. It's just gone.
So that's the fundamental trade-off. The system is evolving to give you incredible speed, real yield on your cash, and direct control over your assets. But the price of admission for all of that is absolute, total, personal responsibility for your own security. So the question you really have to ask yourself is, are you ready for that?